All right. Hello, everybody, and welcome back to another Pepperstone live event here on YouTube. Today, we're talking about another great topic, which is, of course, mean reversion. Probably sometimes the often, I guess I would say, forgotten indicator, Ty. It's what we learn when we first get in the trade, and we forget about it too quickly. And it does tend to be one of the best indicators, doesn't it?
It does. Welcome, everyone. And yes, look, we follow it religiously. We talk about it every day in our streams, and we find it a very, very good mechanism to really identify, not only chances to get in, but also potential opportunities to get out as well. So there are many ways that you can use it. I'm looking forward to delving into tonight to explain some of them.
Yeah, so without further ado, let's get into some of the action. And I guess the first thing I want to be talking about here is going to be mean reversion and what it actually is. But just to go through what we'll cover today's topics, we'll be looking at providing some insights into winning strategies with this type of thing. So with, of course, using the mean reversion technique, how do we build an actual system around it, more importantly, and then also some other extra indicators that we do tend to find that do very, very well for us. So this is a mixture of learning the basics, bringing together some of those basic concepts with a little bit of secrets, and then, of course, analyzing those over the top. So I think it's going to be a great session. Do remember as well in the Q&A down below, if you have any questions during or after, put that in either the comment section or in the live chat, because it always does help us out. Just before we get started, Ty, I guess we've got a quick disclaimer, so we'll see you in just a few moments. So, Ty, the question we always get asked is this: how do we unlock some profit potential? How can we potentially harness some basic strategies? Because they always say keep it simple, smart. That's how keep it simple, stupid. And how do we actually use mean reversion more effectively? Well, first off, of course, if we're beginners, intermediates, or even advanced traders, we need to understand what the difference in moving averages really is, which one we tend to be using, and more importantly, what actually even mean reversion is. When we're using moving averages, what institutions use these, which ones do they use, etc., and of course, what are our favorite moving averages? So, Ty, do you want to take us through just quickly basics here as we are doing a beginner session? What is a moving average, and why would traders want to use it potentially?
Sure. So a moving average is basically the sum of whatever number you are looking at. A simple moving average, for instance, is going to be maybe a 20 moving average, for instance, one of our favorites. It's going to basically calculate the last 20 days movement or the 20 periods of movement and give you the average price for that. So you're going to see what effectively is a line on the chart. So when you're looking at it on a chart, all it is basically a line that is interacting with the price action. So whatever number you have of your moving average, that's the amount of periods for that particular chart. There are a couple of different ways that you can obviously look at moving averages. There are a few different types. The SMA is the most simple. That's the simple moving average. And that is the one that effectively just is a sum of the previous periods, whatever number that is, and then divided by that amount of periods. And that's going to give you the average price. And then, of course, we've got an EMA, which is an exponential moving average, where we've got more weight given to the front of that moving average. So if we're looking at, again, a 20-period moving average, more weight is given to the front half of that period. So effectively, the first two or three numbers are going to carry a lot more weight than the last tail end of a 20 moving average. So it's a lot faster. So what that's really giving us, the exponential moving average, is actually a faster moving average because that weight is being placed at the front of the most recent price action. It does react a lot quicker to what recent price is actually doing. So it has its pitfalls as well, but generally for the smaller time frames, we do prefer the EMA because it makes the moves just a little bit sharper. As you can see here, all the numbers, if we're looking at a 10 EMA, the most efficient numbers are 2, 1, and 3 are given the most weight, and it slowly deteriorates all the way to the tail end of the last 10 periods. So very straightforward in terms of how it works. How it's calculated, you don't really need to know that because the platform does that automatically for you. So all you have to do is load it up and it works the calculation out for you. So there's no need to worry about that. And of course, very important, Tom, it adjusts itself to every chart that you put it on. So if you're on a daily chart, it's counting the last 20 days. If you're on a 15-minute chart, it automatically adjusts itself for the last 20, 15-minute candles. So it always self-adjusts to whatever chart time frame you're on.
Yeah, so 1 hour on the 1 hour, 2 hour on the 2 hour. Even if you chose a 2 hour, 22-minute chart and you made your own custom chart, it would be analyzing to that. So a 20, let's say in this case, SMA would be giving equal weight to those last 20 periods. That is, if it was a 2 hour and 25-minute chart, it'd be 22 hour and 25-minute charts worth of data. So, Ty, there's another one that everyone always mentions, and it's got to do with DMA. So, you obviously see daily moving average quite often referenced. A I guess a moving average that often is considered would be something like a 50 DMA and a 20 DMA, and again 100 and 200. And this is often referred to in reports. So if you're ever looking at a report from a big bank, they'll sometimes mention DMAs as well. And it's become pretty synonymous, I think, with a lot of retail traders out there as well, that mentioning. So when do we want to use MAs or EMAs? Tyron's already kind of talked about it a little bit. We want to use generally EMAs if we're faster day trading, scalping, that type of thing. And we want to use usually a moving average, which takes the whole range when we're doing something like a 200. So effectively, if we're looking at 200 width of everything, we might be saying, okay, well, it doesn't really matter about the last couple of days or hours or 5-minute chart doesn't tie. It's more about the sum of the whole.
So when you're really looking at 100 and 200 moving averages, you really want the actual the steadying price. It's no point giving weight to the first 15 or 20 periods in that moving average because there's just too much at the back end. So we keep those simple. And realistically, though, when you're looking at a 200 simple moving average, that is what the world standard is. So quite often you'll hear the big major reports talking about crosses of the 200 moving average. They're generally talking about an SMA, so it's no point changing it to an EMA because we just don't see the benefit of it. It's just not the one that you want to be doing. The most popular moving averages, though, like across the board, you can see here we've got a 20 moving average, a 50, a 100, and a 200. They're the most popular. The mean reversion is generally regarded as a 20 moving average. And if you do have, just as an important note, if you ever have a Bollinger Band on as a standard setting, as a default setting, and you've got a 20 moving average on your chart, you won't see the middle band of the Bollinger Band, or you won't see the 20 moving average depending on the thickness of the indicator that you've got on, because they simply are the same thing. Okay, so it's very, very important to know that. You might think that your indicator has disappeared, but no, in fact, the 20 SMA is what the mean reversion middle Bollinger Band is. So just be mindful of that if you think it's disappeared. It shares the same frequency, really.
Yeah, so the 20 moving average is heavily used in stock markets. Let's say you're trading the S&P 500 or the NASDAQ. I'd encourage people that are watching this video, maybe go put it on your charts, have a look at a 20 weekly moving average, and you'll find that often markets will come back and it will act as what we call dynamic support or dynamic resistance, which is a very critical point. It can also be an area where some people look to do things such as dollar cost average. Of course, you need to bring it together with other concepts, but it's widely considered one of the most powerful trading strategies that's super basic in the markets. And you might think with algorithms, with the beginning of AI everywhere and everything like that, that maybe the 20 will stop working. Well, do remember the reason why the 20 is so powerful as well. If you think about it as 20 days, that's about the number of average trading days in a month when you take out public holidays and weekends. So effectively, the 20 moving average is so much more than just a number. It's also that psychology component that humans tend to get behind. You'll notice that even when you think about 50, 20, 100, and 200, they're very round numbers, and they tend to lead into also pseudo quarters, things like the 100, or might be like a little bit more. And that's something that I do tend to find is really, really powerful. Thinking about the psychology of an indicator to us as humans can be a very powerful technique. Now, Fibonacci tuning as well, Ty, 5, 18, 13, these types of ones are also quite popular out there, aren't they?
Yeah, they are. Yep, the 5, 8, 13, 21, they all basically build themselves up. All Fibonacci numbers are generally regarded as very important in trading, and a lot of people. So when you first start out trading, if you look at a lot of the forums, you'll see people talking about a 5, 8 cross or a 8, 13 cross. What they're referring to there is the Fibonacci numbers. Okay, so as we know, a 5, 8, 13, 21, the Fibonacci numbers build upon themselves, and they do go right up. What we find, though, generally speaking, up to the 21 is about the most that people take it when it comes down to moving averages. It doesn't usually go much further than that because it gets lost in translation. But look, a 5 and an 8 cross or even an 8, 13 cross, and sometimes Thomas a 1321 cross, a lot of people actually believe in as well, can be very, very sharp movements. They can give you very, very sharp entries and are very, very responsive to the market movements. So if you are a day trader, using the Fibonacci numbers in that way is not a bad method, using those moving averages, using the EMAs. But just be mindful, though, that with that speed sometimes comes false breakouts, right? So there is always a little bit of give and take. It's not always in your favor if you get in very, very early. Sometimes those signals are a little bit false because they can travel a little bit too quick, aren't they?
They certainly can. So, question always gets asked, mastering market momentum. Okay, we might know that moving averages are pretty good. We might know the 20 moving average or mean reversion is often considered one of the most powerful on the day and the weekly. But how do we actually unleash any power using moving averages and use them as potentially dynamic support resistance, or even bring a strategy together with this? So we'll be taking a look now at how we even use these moving averages as support and resistance. Which do we tend to use the most? And of course, what little secret kind of method could we be using? The 1-2 method a little bit later on today. So Ty, it's all about understanding direction when it comes to markets. They say the trend is your friend until the very end. Oftentimes people use the moving averages as a way of exit liquidity. So remember, in trading, it's not just about entry. It's also about where's your stop loss going to be? Where's your take profit going to be? And do you have a dynamic system? And I think a lot of people don't think about markets as dynamic. When we all first get in, today is more of a beginner's strategy. So today is, understanding that we always used to tend to have like a fixed level. A lot of people say, I scalp 10 pips or I scalp 25 pips on currency or something like that. They won't tend to have a market adaptive system. Well, moving averages can be the first beginning step of creating a dynamic system, especially for take profits. So if the market went underneath, let's say this particular moving average tie, let's say that was a 200, which is often considered on a DMA, so on a daily moving average. If the price had moved underneath that, what might we do if we had longs in the market? Just
look, at the very, very least, we'll be on a very, very high alert, right? Like when we get across of that very, very important moving average, we're going to start looking at it and saying, well, this market may well have turned. A lot of very, very big institutions and reporting agencies often determine that when price is above the key moving average, like the 200, you're in an uptrend, and when it does cross down below the 200, you're in a downtrend. So if you are in a technical downtrend because we've broken a very serious zone, you have to be on alert that a lot of very, very big players are treating that as a downtrend or a change in momentum. So at the very, very least, if it was me, I'd be taking some profit, Tom, knowing that we're in for a potential downward move, knowing that we're in a technical downtrend from that point. It's not a price action downtrend. It's actually a downtrend of a break of a moving average. So, and again, trading is one of those things where a lot of people see it, a lot of people trade it. Therefore, it has to be respected, right? It's not a case of a number we've just made up. The 200 moving average is an extraordinarily important moving average in so many ways for so many different, areas of trading. So it must be absolutely respected, whether it's actually just the number or whether people's sentiment changes. It could be a combination of both. So you've got to be very, very careful around that level.
And we've also got to build confluence. So just in this strategy here, let's say that was the 200. This is obviously two levels of support or demand if you're a demand supply trader. And this is where you can build a 1-2. Now, we're not talking about the 1-2-3 just yet, but what we are saying is, you breach and you close underneath here. Maybe you need to start thinking about the trend potentially changing. We have a high, we have a low, we have a higher high. So that's traditionally a upward trend. But what happens when we make a lower low? Well, then suddenly we're changing trend, at least on that first time frame. So we have two supports, they're being breached, the 200's being breached. We've had a close below after making a higher high. It could be time for us to start to descale the position or potentially exit. So straight away, moving averages can be used in that way. Potentially an area where you can look for crosses of them, or more importantly, I believe, price breaking up and below. So people use moving averages for a lot of things. One of them is determining trend direction. Condition one, often we talk about, Ty, is when price is below the moving average, the market would be in a downtrend, whatever that would be. And when price is above the moving average, the market will be in an uptrend. And that's a good way of using a basic. Again, the hint here today would be to say 200-day moving average is pretty good. And that's usually the one that I would go with when it comes to moving averages as a good kind of ruler of trend. And then down in the lower time frames, when you're scalping and day trading, you could say, well, what's the higher time frame look at? Put a 200 on there, get a little bit of an idea. Hopefully you understand some price action concepts as well, along with that, of course. But yeah, dynamic support and resistance. So do you want to walk us through how we might use this along with maybe some basic price action concepts?
Absolutely. So when we're talking about a downward trend, generally speaking, we're looking at price action being the moving driver for that. So we're looking for a series of lower highs and lower lows in price. So we can see that we've got this on this chart. We've got a series of lower highs and lower lows. But as you can see, each of those red circles is representing a touch of a very key moving average. And that is proving to be dynamic resistance. And it's dynamic because it's adjusting itself to what price action is doing. So remember, it's basically forming its level by the last 50, in this case, 50 candles. Okay, so it's going back 50 candles and determining its level using the last 50 candles. So it's coming down as price is going down and giving us that dynamic level. So when people talk about traditional support and resistance, that's obviously a horizontal line that's static. Okay, the dynamic nature of moving averages gives us far better entry points because once a level is broken, it is actually moving down consistent with how price is moving. And as you can see in this example, it basically came down 3 times 3 very solid entries to continue with the trend. And then when it actually got to the bottom and we saw a change of trend, the very first change of trend that we can actually see on this chart, it actually broke above that moving average and started to form a series of higher highs and higher lows. And once that happens, that's our first sign, our first very important sign. The price action has actually changed trend, and the prevailing trend is now long from a downtrend. So that's really, really important that you can see that. Most important, you can see that it actually broke up above that moving average. So whilst it was actually providing dynamic resistance all the way down, once it did break up and made a series of higher highs and higher lows, it was trading above the moving average, which is another, like Thomas said, another confluence method to show the 2 different reasons why there is an uptrend. Both of them for their own, I guess, their own reasons, but it's certainly there. On the flip side, in an uptrend, you're going to see a very similar pattern. This happens all the time. Now, this is not like a hand-picked moving average that we've just plucked out of nowhere. We can open up any chart and you're going to see this happen. But in this particular instance, you can see that we've got 4 very, very important touches of the moving average on its way up. We know we're in an established uptrend. Okay, we've got a series of higher highs and higher lows, as you can see. What the dynamic support is giving us is the opportunity to actually join this trend, a well-established trend that we already know is in place, but it's giving us very key entry points to actually get in on that long. So once we're getting all of those things happening, we're getting all of these extra reasons to actually jump on board. So not only is the support level a level to show us when the trend is actually ending, which you can see what happened at the end, it's actually giving us really important entry points on the way up. So a lot of people say, how do you enter a trend? How do we stop from jumping on a train that's already left the station? Well, moving average is your answer there. When you see pullbacks to the moving average and a sequence of higher highs and higher lows, you're getting that perfect entry point.
In single stocks as well, especially when they're large, 20 moving average in particular, you might notice in the 4-hour, 2-hour, or daily, if you put those on the charts, what will often happen is you'll get a market that pulls down to one of those and it will do what we call the 1-2 method. So stick around. We'll just go through that in a moment. But here's some examples that I took recently, and they all came actually true. Now, these were taken, of course, before everything started to turn, but I just want to kind of point out how important this level was. And that was that we had the S&P 500 here, an example, and it breaks out from this key critical zone. We start to get 20 moving averages. We get a 1, we get a 2. At that point, you're starting to say, well, maybe I'm starting to see something. I call it the 1-2 method. You get 2 touches of a moving average, whatever that might be, 20, 50, 30, whatever you're using, and it comes off a significant breakout. This is a very basic strategy, but it's very effective for being able to see that replication. And I would argue it's better at entering than a lot of people are with very fancy systems that tend to get over a little bit too crazy with things. What you're using is using a higher time frame to analyze a key breakout. Once the key breakout happens, you're looking for a replication of that move. So again, it makes sense. It's common sense here. And then once you see that being tested, you start to think, okay, cool. Well, as long as we're making a series of higher highs and higher lows, which is, of course, a price action-based trend method, then you're doing okay. And what happened recently was the S&P 500 breached below the 20 moving average. And since that point, it fell all the way back down to here. And actually, if you go and have a look at the charts after watching this video, you'll find the 20 has been a spectacular moving average for some extremely good entries on the smaller timeframes. Here's an example of another stock. Now, you could guess and pause the video if you knew what this one is. You'd be pretty smart. But if you don't know and you're watching now, you would say it's Apple, and it is a very, very well established trend. So again, Ty, a 1-2 method. We breach a key level. So again, comes from a price action base. Then we have a series of higher highs and higher troughs. So we have a 1 after touch. Good. We have a 2. Okay. We've now seen it. We make a new higher high and we come back down to it. If we then see a nice entry on the smaller timeframes, we know that's a key level. We know that's a key level. We get a 3, we get a 4, and then, of course, we get a 5. Now, eventually it's going to fail, and it did, and it led into significant weakness. And, in fact, again, some nice touches of that particular moving average. So not to be underutilized, the 1-2 method, whether you're using a 20, a 50, a 30, a 100, a 200, what you'll find, well, generally I wouldn't use 200 probably, but generally you'll find that this is quite effective. The key to it and the difference between you and an algorithm here will be understanding what is a key breakout. And that's going to come from price action basics. And it's something that we've covered many times here on YouTube. So definitely check out some of the other videos down below as well. And you'll find that there's some advantages there. So how good is the 1-2 method, Ty, in terms of recognizing these? I thought it was one of the best when I first started all those years ago. What are your thoughts on the 1-2 method?
Yeah, most definitely. You're getting two things in your favor. You're getting a warning that a breakout is about to happen, and then you get confirmation that breakout has actually happened. Once you have confirmation, you've got momentum on your side. Not only do you understand that the market forces are with you, believe it or not, you do want to be with the market. You don't want to be fighting it all the way. But most importantly, though, it's giving you the opportunity to actually reload or actually enter at that point. When people look at a candle, especially a daily candle, they can get a little bit lost in the translation of how do you get in that. But if you go back to the smaller time frames and you see a big move, very often you're going to see, it could be a 15-minute chart, it could be a 1-hour chart, pullbacks to the moving average. Now, you can see that we haven't got this chart labeled with any particular time frame because it's irrelevant what the time frame actually is. Correct. And I think that's the point of it. You can basically find these patterns in any chart. Of course, generally speaking, the bigger the time frame, the more important the chart is. But this could be a 1-minute chart or it could be a daily chart. You're going to see a very, very similar scenario happen. And that's the beautiful thing about trading. You can adjust your plans and you can adjust your charts to what you really have time to do. If you're a scalper that you're going to trade the London Open, you're going to find a chart that's going to give you this sort of method. It's going to be maybe a 5-minute or a 1-minute chart. But if you're a weekly trader or a daily trader where you haven't got as much time, you're also going to get the same effect on a weekly and a daily chart.
So an example here, Ty, maybe London Open, great one there. This is actually currency I've taken it from. London Open happens. Let's say it's a small time frame, breaks to a new low. Okay, maybe that's the trend, but we're not sure yet. We're a little bit scared. Then it comes up during one of the session. Then it goes down. Then it comes up again during the session. And you can say, okay, well, next time. Remember, this could be a 1-minute chart, could be a 5-minute chart, could be whatever. I'm going to keep taking it until it proves otherwise. And you'll find that usually number 3, number 4 have decent strike rates. So again, it's about replication. We have to be able to replicate our strategy and then go from there. So which is our favorite moving average? Well, we've said it many times here before. So we're both going to say 20 moving average. But I'll also say that, look, the 50, 100, and 200 are all excellent. I think the 50 is being used pretty heavily at the moment in the markets. And I'm going to go with which is our favorite time frame, Ty, as the question here. So I'm going to put it to you. What's your favorite time frame for using moving averages?
My favorite time frame is definitely the daily. And the reason for that is daily is probably significantly the most important chart that you're ever going to look at, no matter what you're trading, whether you're trading the 15-minute scalping chart or if you're trading a long-term investment chart. It gives you your entry point for the longer term. It gives you your direction for the smaller time frames when you're trading in a scalping mindset. So the daily is my favorite, and the 20 pullbacks to the daily are obviously my favorite as well. So combine the 20 moving average with a daily chart, and you're going to make Tyrone very happy.
All right, my one is going to be in Forex, the 4-hour chart. Okay, so if we're trading, things like currencies, I think the 4-hour chart's pretty exceptional, and that's a good one. If we're talking stocks, weekly, all day, 20 moving average, 200, love those things. So I cheated, but I got 2. But yeah, realistically, the point is that you can cut it many different ways, and it is also sometimes instrument selection specific. But all of those are good. 4-hour daily, weekly, particularly good for this type of stuff. All right, guys. Well, let's have a look now at something else. So, swing to success. This is often a question that we get asked. What is the best and most effective way of trading when it comes to swing trading, building together a mean reversion strategy, and really bringing together a couple of different tools? How can we do it in a keep it simple, smart way? Well, we can do it because we bring together indicators that are different. That is, we select the best time zones we want to trade. We start with a strong base, generally some kind of price action base. We'll give you a basic one in this video today. And then, of course, we'll begin adding confluence indicators. We generally want to have around 4 to 6, maybe even 7 different confluence indicators. And at any point in time before we take a trade, I like to have at least 3 minimum. Generally 4 or 5 is a spectacular amount, isn't it, Ty?
It is, yeah. If you can get 4 or 5, it's a very, very good reason to get in a trade. But obviously, that doesn't mean you throw the right. Yeah, you've got to use the right indicators to actually get in, right? There are a lot of indicators out there that replicate each other. So we're not talking about finding 5 replicable indicators that tell you the same information. That's cheating, Tom. I know you guys might be out there thinking, I know 5 indicators that are very similar. No, if you're only kidding yourself there. You got to be very careful with that.
Absolutely. You do need to be very careful. So we have to make a decision. What are we going to trade? Generally, with moving averages as a system, if you're going to trade the Asian session, you're probably going to want to be more of a swing-based trader and use your information from the back of the US session, that is the daily close, and then go from there. I like London session for breakouts and anything to do with liquidity. So we're looking for those liquidity breakouts, things like the London session, things like the overlap between the London and the New York session. They can be some of the best provided when it comes to time zones. These are some of the pairs, single stocks as well. Spectacular for mean reversion, possibly the best single stocks. Some notables out there that you could go and test off this video. Remember, mean reversion is the 20 moving average. Would be things like AAPL, so Apple, Tesla, and then you could go Microsoft, and a lot of the big, more notable stocks, even Disney at some point, and all those types of things. What you'll find is the more liquid they are, the more likely they will respect a lot of these key old style indicators, such as the moving average. In currencies, these are some of the ones you might want to look at. So how does a large trade actually start? Well, we've talked about it many times, but basically, Ty, there's a build of a position, isn't there? A large liquidity provider or large bank builds a position over time, and often we'll see builds represented by what many people call a channel or a range-bound market. Then suddenly they'll break out. This is the key to using moving averages. If you use moving averages inside of a trapped moving trend, that is basically a trapped trend within a high and a low, you're going to get destroyed. And it's why most algorithms will fail with moving averages without some good detection of when you're in a kind of channel. A good tip here, Ty, for channeling would be a 1 touch to the bottom, a 1 touch to the top, a second touch to the bottom, and a second touch to the top. Once you get that 1, 1, 2, 2, as I call it, you generally can say, okay, we're in a range-bound market. Stop using all moving average systems until we get a new breakout. And I find that to be a very effective tool. But how important is it to only be in trend when it comes to using moving averages as a base?
Yeah, most definitely. Look, the moving average is going to be your best friend in the way a momentum trade is moving. Price action is obviously the number one consideration. A series of higher highs and higher lows in an uptrend, or a series of lower highs and lower lows in a downtrend. They complement a moving average very, very well, because that's when moving averages provide dynamic support or dynamic resistance. In a flat market, you're going to get what we call a ribboning effect most of the time, especially on the smaller moving averages, where all they are doing really is just running horizontally and basically ribboning each other, crisscrossing the moving averages, and prices hovering somewhere in the middle. That is not when a moving average is useful. In fact, when it's doing that, it may as well not be on the chart, to be honest. But when we know we've got a confirmed break, it's a very, very different story, because then we've got price action dictating the way, and the moving averages are doing their job, giving and offering dynamic support on the way up. And guess what? If you want to join an uptrend, where's the best place to buy? At a level of dynamic support. And conversely, on the way down, when we've got a series of lower highs and lower lows, where's the best place to either enter a position short or potentially take a scalping long opportunity if you're counter trending as a dynamic resistance? So that's where they really come into their own.
Yeah, so dynamic resistance, dynamic support, I think they're the best kind of ways to trade often when it comes to moving averages. But we also want a sequence to start off any kind of trend. So in general, you want to be taking out, remember, if you're in a uptrend, you want to take out that lower low, or in this case, the low and make a lower low. If you're in an uptrend or you want to start an uptrend, you want to take out the previous high. Okay, that's a great way of looking at it, especially around those liquidity grab zones or liquidity beginning zones that you tend to see at the beginning of the New York session, or of course the London session for both currencies and indices. Another way of building mean reversion into your system would be understanding the concepts of role reversal. That is where resistance becomes support. Imagine if you have a moving average creeping up and then all of a sudden the market breaks out to a new high. You're confirmed. You're like, yeah, that's pretty strong. I like that very much. I'm looking towards a bull position. Then the market pulls back to a level of support. And at the same time, it's tapping into a moving average. Let's say this was the 20-day moving average, and you were looking at a 20-day here. And basically, it's hitting the same level of resistance that is now becoming support. Okay, that's one reason. It's hitting the moving average, which is mean reversion because it's the 20 in this case. So you're getting that tap of support or dynamic support, and you're starting to build together a really good strategy. And if you had what we call the 1 and the 2 system with that, which is where you already had a touch of price previously twice to that moving average, then the third one in particular, or the fourth one, or the fifth one, or the sixth one with this system, it might be almost enough to go with by itself. Very simple strategy. Go back and test it maybe on your charts. I think you'll be surprised how good it can be.
One of my favorites.
Yeah, Ty. I mean, we started with this type of this is pretty much the core basis of our beginning strategy when we first started all those years ago, 15 years ago. We used a mixture of moving averages, obviously a Bollinger, which turned out to, of course, that would give us the 20 anyway, but we would use Bollinger to give us TP zones. And then, of course, we would have a mixture of resistance, support, kind of concepts of role reversal. And then we would also bring in a whole bunch of different indicators into this, which we'll talk about a few in a moment. But here's just an example of role reversal, how it might look like in a chart. And what you might see is when it slows down here, the 20 will play catch up, or whatever moving average will play catch up because you're getting a lot of range bound. And then it might be actually that it might have touched here and then it would touch here as well. And then, of course, that would give you that extra confirmation. I would guess that there is certainly a moving average that touches in that zone that's probably pretty relevant to this price.
Extraordinarily likely.
Yep.
Very, very likely.
I don't know which one it would be because, but I'm pretty sure. And look, that's a 4 hour there on the Euro USD. What's another level of confluence we can bring together when we're building a strategy, Ty? Well, another one would be, of course, Fibonacci. And the reason we could use this is because often we're pulling with Fibonacci from the last low to the high or the high to the low. And remember, we always want to draw left to right when we're pulling these Fibonacci's. That's something I see a lot of beginners make huge mistakes on. They draw the Fibonacci backwards. Well, that's not going to work out for you, unfortunately. Yeah, so here we've got a resistance, and that resistance is just tapping into a 61.8 support line. So basically, if the market comes down to this level, again, what if there's a moving average there, which is hit here, then it's hit here at the same time as we're seeing the resistance become support, at the same time we're seeing a 61.8 fib. We've built 3 different systems over the top of each other. That's building confluence. It's a very powerful concept, and I wouldn't mind that trade. I think it would be pretty good.
That's a very good trade, and all those reasons are very, very unique in their own way. That's what I was talking about. When you have different reasons for actually placing a trade, you're using, in that instance, you're using momentum, you're using Fibonacci, you're using a pullback to a very key level. They're all very different reasons to enter that position. If I see that, I'm very, very comfortable.
I would be pretty comfortable with that one as well. I wouldn't mind it too much. So I'll just take our faces away here so we can have a look at this. So when we're talking fib, some good rules of thumb to stick with is use key levels, 23.6, 38.2, 50, 61.8, and I like the 75. If I had to pick myself, I'd go with the 61.8, 75, and a 38.2. They're my favorites. Ty, what are your favorite fib levels?
My favorites are the 38.2 and the 50, actually. They're my 2 favorites because I like momentum going in my favor and not losing too much traction. So that's my particular style, the 38.2 and the 50. But the 61.8 is also an awesome pullback. And yeah, it is so popular that you can't help but respect it when it comes in. The 38.2 and the 50 are certainly my pick.
Yeah. So look, again, it's good to have a little bit that they all work. It just depends on, again, how you're stacking that confluence as well, how you're using them. So let's bring together a little bit of a question here, Ty, and it goes to do with what we would stack together with mean reversion. In my opinion, mean reversion, such as the 20 moving average on a daily, we would want to stack it with Fibonacci as a great underpin. We would also want to use some type of role reversal would be really powerful. Supply and demand would be a really powerful concept. We could use Bollinger's for take profits as well, which would help us to give us a 20 anyway on the charts, but also it would give us the standard deviation. So as the price moves up, you'll often find that when it taps the top of that Bollinger, maybe that might give you the risk reward that you need and begin your process into dynamic take profits. So that's a huge component. What other indicators would you add to a mean reversion system?
Yeah, look, I like that. One thing you probably could use that we haven't talked about in today's video, but volume profiles. We have gone in those in the past. There are definite potential use for building a case for a mean reversion system, because mean reversion does actually it factors in that a price is reaching a level that the market is quite comfortable and where you're going to look at potential reload. So you want to be on the lookout for potential pickups in volume from those levels. And realistically, those alone would actually get the job done. RSI can be used, but probably not as effectively in a trending method. You can probably use that in the sideways market, but in the trending market, you probably you're not going to get the best benefit of an RSI. But yeah, most definitely, probably the Bollinger is one of the most important, but important to make sure that you understand where the standard deviations are. And if you're using the default as 2 standard deviations, but they can be very, very influential, especially if they are combined with a Fibonacci pullback of a 38.250 or a 61.8.
Yeah, it could be really powerful to use all those concepts together in terms of being able to define areas. So let's just jump over to the charts here quickly, and we'll just jump into the Euro US dollar just to bring together some things we're talking about today. So first up, I'm just going to select here, and I've got a 20 SMA. Okay, so we're just using a 20 simple moving average. I made it red because why not? And I just want to show you, kind of the 1, 2, 3, just as like, a concept you could use. So here we have a market, and I'm not using anything particular. I'm just showing you this is what did happen, where we've got a 1 touch after getting a fairly significant change of trend. So in this case, we actually have a price action based start. So that's good. Because we have a price action based start, then we're looking good. We've got a high, we've got a low, we've got a higher high, then we get a lower low. Turns out that's in the direction of the overarching trend as well. Spectacular. And then we get a 1. Okay, cool. Then we get a 2. All right, cool. Then we get a 3 and we get a 4. So we actually get, and that did make a lower low. So you would have been able to take both those. So you got a 3 and you've got a 4. And then, of course, we get a 5th and we don't get the lower low. And then it comes back again. It's over. But what you'll find is there's some profit to be made here still. What if you dialed in on the small timeframes here? And although it might not look like that much, this is fairly replicatable. It's got a great start. And therefore, you've got a 1-2 system on top. Remember, I had absolutely no idea it was sitting there. I just kind of blowed up the euro just to show that the 20 is respected. And more importantly, the 1-2 system is quite common when it comes to actually having a trend-based system. We've got a price action-based start here, Ty. We have touchbacks, which are important. And of course, I'm sure we've got some fibs as well with at least that first reversal and even the second one. So we could load fibs from the high all the way to the low. Now, I don't have a 38.2 or a 50 sitting on this particular fib right now, but eyeballing that, I reckon it's a 38.2. You'd agree with me, I assume?
Yeah.
Yeah, it looks like a 38.2 to me. And then if we actually took the last one where it still made the lower low, which was important, the one in here, well, that's going to be a 61.8 for sure. So it just shows again that we do have some nice pullbacks. And in a situation such as this, the first one, you're probably not expecting it to come back to a 61.8 that often. But this other one, because it only just barely made a lower low, you're more likely to want that 61.8. But guess what's happening? It's a fib sitting on a moving average, sitting on a 1-2, sitting on the beginning of a trend, sitting on trend is actually down at that stage. Then it suddenly reverses in price action here. And of course, you would completely stop using it anyway because it broke the 20. So just an example, that could have gone on for 10 runs in a row. It's possible. And in single stock in particular, it can do so.
Most definitely. We've seen it happen. There is never an end until a higher high, higher low, or a lower high, lower low sequence actually is in place. So really, there's no number that you can actually say definitively it's going to end now. I've got to be on the lookout. It doesn't end until the price actually changes direction. That's very important.
Yes.
Don't try and preempt.
Really important to stick with that. So we'll hand over some questions that are coming into the room now, Ty, so that people here that are interacting with us live can get some answers. So we'll give a bit of a shout out here to some people that joined us. We've got Aussie Cobber. We had a few that joined us early as well. We've got Braden, Roman, Mohan, Bass Creative Media, I think. Some examples here for moving averages that people use: 20 EMA, 50 EMA, popular here with Mohan, and a 200 simple moving average. Yes. And then Bass Create Media says best is the EMA. Here we go, 4-hour lover. EMA 50 on the 4-hour there. And that's pretty spectacular. And then we've got Eric coming through here and said the break is not always very clear. Here you stagnate for 5 periods before having a wick totally outside of the break. So if you mean I'm wondering what you mean by that break in terms of the break is probably, well, you could say it's this one here just in terms of it comes through particularly. But there's 2 ways you can do it. One way would be saying the change of trend happens there anyway. So I can tell you that price action will help you to determine that. And if you don't believe that that's the break in terms of, let's say you'd say, wow, that might not be clear to me, which I can understand. That's fair. Then I would use price action to overcome it. But sometimes it's just going to be clear. It's going to be a huge candle. And that's going to be very, very clear. Once that huge candle gets a new high on it, it's over. Okay. And that's just how it is. You're looking for that higher high kind of aspect. And in this example here, the higher high aspect would happen at that point there. So we get that close above. I'm confused. Fair enough. Then you get a candle down. Okay. Maybe it's going to go down again, Ty. Yeah, it's possible. And then all of a sudden it makes a higher high and it whips out that last previous high. It's probably over at that stage. And that could be another method you use. But I would say price action to stop and finish it along with the 20 moving average would be an exceptionally good method there.
Yeah, great.
And hopefully that helps, Eric, if you know what we're saying by using that concept. All right, guys. Well, that brings us to the end of today's beginner session. Obviously, we do perform these here over on YouTube for Pepperstone every week. I encourage you to go back through some of the history because we have done some more advanced, some intermediates there as well. And yeah, basically start thinking about the 1-2 break system, start thinking about mean reversion, put the 20 on your chart, even if it's in a Bollinger, and even the most basic stuff. Sometimes you'll learn something new in each one of these sessions. So we do always encourage you to come back. Give it a big thumbs up if you enjoyed today's session. And Ty, from all of us here at Pepperstone, we hope to see you next week, don't we?
Absolutely. Thank you so much for giving us your time tonight. And yeah, we look forward to seeing you next week with another topic. So definitely give us that like if you're enjoying what you see. And hopefully you've learned some good information.
Just quickly to finish up here, Eric says, thank you. That seems to help. And he says, I also look at TP when different price happens. EMA is big enough. And then Adam says here, do you guys ever use the Bollinger Bands or Keltner channels? Yeah, I use Bollinger quite regularly. There's absolutely nothing wrong with Bollinger. It's a good one. Keltner is also quite widely used, isn't it, Ty? What's your opinions on Keltner?
It is. Keltner is used, but I think you need a method that really suits the Keltner channels. It doesn't work. The Keltner channels don't work greatly with a lot of the indicators that we talk about, but in its own right, it is a very powerful system as well. But I think it doesn't play nice with every single indicator that we've talked about tonight. So if you are using it, you've got to adjust your strategy towards it, but it certainly does work.
Yeah, I think like anything, it's like, an alligator or something. You want to make sure that you use it when it's right to be used with other things. So it's kind of like Elliott wave. Elliott wave's a great concept if you're, I believe, if you're trying to hold a larger position, and also you can stack it with certain indicators, but it's not harmonious with everything, if that makes sense. So look, Bollinger can certainly be used alongside a standard kind of ribboning effect of moving averages plus price action. And I would suggest people play around with Bollinger. We might do a special on it. Who knows? Sometime soon. I think we've got one in the cards actually for Bollinger. So make sure to subscribe to the channel. Thank you so much for watching. We'll see you next time, and bye for now.
Thanks, everyone.